If you watch the news, you might have heard the term before, earnings, and in conjunction with earnings per share, which is sometimes abbreviated as EPS. And you might be wondering, well, what does this mean? What is EPS? What are earnings? What are we talking about here? So if we just come back to our basic discussion kind of the income statement, so we've got revenues, then we've got expenses that we're deducting from revenues, and ultimately we end up with net income. Well, when we have this net income figure here, we can go ahead and we can think of it as kind of like a pie that we've got, in that pie can be distributed or spread out. So let's spread this out. So we've got a bunch of net income here, and it can go and it can be cut up in all these different ways. And maybe you hold one share among all. Each one of these is a share, and you hold one part right here, and so you have a claim, kind of in a sense, on this net income, this profit that was generated by the firm. Now you can't go and say, okay, I want to make a withdrawal, give me my dollar or my $2 or something like that. But in theory, you've got a claim on the assets of this firm. You have some equity here, and that's what we're talking about. Is we're saying with earnings per share, we're going to take the net income or earnings. It's just earnings, just another way of expressing the net income or profit, the earnings of the firm. And we're going to go ahead and we're going to take those earnings, treat it like a pie, and say, okay, well, given how many shares you own, what's your portion of the pie? Maybe you own a lot of shares and you end up with close to half the pie or something like that. So we're going to go ahead and let's talk about this in a little more in depth and figure, okay, well, why is this important? Why do we care what earnings are per share? Why is it important to spread it out among the number of common shareholders and so forth? Well, let's think about this. So you've got company A here and then company B. Now they each have the same net income. So they each have a net income of $1,000. But think about it. Which company would you rather be invested in, all else equal, assuming that they have the same business model, same product, and everything? And here we've got 5 shareholders, and then here we've got 978. So this net income can be thought of, this earnings can be thought of as kind of an increase in the equity of this company. And so when there's this increase in equity, would you rather split that with 4 other people, assuming you're the 5th, obviously, or assuming that there's 5 and then you want to be the 6th? Do you want to get in on this, or do you want to split with 978 people? We've got the same pie because we've got 1,000 in each case. So we've got the same pie. Do you want to split it 5 ways, or do you want to split it 978 ways? Which I can't even draw that, so I'm not even going to try. So when we think about like this, obviously it makes sense that the earnings have more value to you the fewer shareholders there are. So when we think about this, we can really scale earnings by the number of people that you have to divide those earnings with. So how is this important in the real world? Well, let's talk about this. We're just being theoretical here, but when we think about EPS or earnings per share, we'll just call it earnings here. A lot of people sometimes say things like, okay, well, we can look at the price to earnings ratio, and we call that like a PE ratio. And you might have heard that on like CNBC or something. You hear about this price earnings ratio, and you wonder, well, what do these things mean? Well, we can talk about things like, for example, a firm's stock price. So let's say that the stock price of a firm is $10. It's $10 for a share. That's kind of assumed, but I'll put that in. So it's $10 to buy a share of this firm's stock. So, well, what are their earnings? Well, let's say the earnings per share. Let's say that it's $1 a share. So what we can think about this is, one way of thinking about these earnings per share is we can, and the firm and whether it's a good value, we can say, okay, well, this firm trades at, you might have heard this before, this firm trades at 10 times earnings. 10 times earnings. And we could also, so let's say we had another firm though, and then this firm, the price was, let's say your price was $17 a share. And then we had EPS of $1 a share. Okay, now let's assume that these two firms, this is firm A, this is firm B down here. So let's assume that these two firms, all else is equal, and they have the same kind of model or business model, or we feel equally confident about each of these firms, and we're trying to determine which one is a better value, which one would be a good value, a good price, right? We think in the store, when you're buying groceries, you weigh the price of different things, and you can weigh the quality and all these different things. But with stocks, it's kind of difficult, and so we just have the share price for each of these. And then we have what the earnings are. And we can look at other things too, like the balance sheet, but this earnings is kind of a good way to kind of condense the most recent operations of the firm. And so we can say this firm up here trades at this firm trades at 17 times earnings. So maybe we think that assuming we feel the same way about the health of each of these companies, we could say that this one is $10 a share. We're still getting $1 of earnings, just like we're getting $1 earnings. Well, maybe this one we feel like is a better value. Now there might be reasons that this might be the case, that we have $1 earnings per share for each one, and then the one is trading at $17 a share. Well, it doesn't necessarily mean that the $17 one is overvalued. We have to be careful, because it might be that they have more growth options. So it might be that this other firm with the $10 a share, maybe people think, well, they don't really have a lot of room to grow. They've maxed out. This is $1 a share is about all they're ever going to be. But this other firm, people might think, oh, well, you know what? I don't think it's going to be $1 a share next year. I think it'll be $1.50, because this firm has these growth options, more growth options, and they've got a better future. So that might explain why they trade at a higher price per share. But when we think about how many times a firm trades at times earnings, 10 times earnings, 15 times earnings, where it's just kind of a benchmark that we can use in terms of determining value, just kind of a rough estimate of value for firms.